pull track on growth just to have these kinds of conversations. And we're having an IMC, we're convening our IMCs to talk about how can they be part of that solution. And really, railroads are running well right now, as we know. The dray carrier space, there's a little bit of a, the exiting of capacity, as we know. But overall, conditions are ripe for us to not just capture the growth, but retain the growth. And so that, to me, it starts with we've got to be part of the coalition of the willing to talk about it.
Great. And thank you so much.
Man, we gotta have you back. We got there's so much to talk about. We didn't even get into like half of the stuff we had because there's so much going on in the world. Really appreciate it. Best of luck to the rest of the year. Best of luck to your event coming up not too long.
That's right. Now. We're going to take a quick break, and when we get back, we're going to dive into the SONAR data.
It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/FreightWaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
Date for you today. We'll dive right into that data.
Contract rates could go up as much as 50 cents a mile. That's at least what the SONAR data is suggesting over the next year. And the reason we know that is we track the line haul rate and look at the delta between spot and contract. And what it's telling us is that there is a massive spread between the two numbers. It is unmatched in any time in history except for the extremes of COVID. The fact that we are at 27 cents a mile in line haul for spot over contract is a very unusual development. If we go back to more stable markets pre-COVID, the spread was negative 35 cents to negative 50 cents a mile. In other words, it was, when you look at line haul only, it was 35 to 50 cents a mile cheaper to move freight by spot than it is contract when you factor in fuel. This is really important because it tells us a lot about how the market is going to move. And one of two things need to happen. Spot rates need to come down significantly by as much as 50 cents a mile, or contract rates need to go up. There's no suggestion that spot rates will go down anytime soon, not significantly at least. We might see some, slowly conditions in the spot market with a couple of pennies here and there, but nothing that suggests that we're going to see an absolute collapse in the spot market. And the reason we know that is tender rejections are still well above 16.5%, a sign just how tight this freight market is. Now, the question on most people's mind is, what do they do with this? How can they use this information to really manage their business? If you're a shipper, prepare to pay more for contract rates. We've talked about it. The spread is just too significant. Carriers are going to be allocating freight to the spot market and pulling freight from the contract market to take advantage of those high spot opportunities. Or they're going to find shippers are willing to pay them much higher. We have talked about the pressure, the LMI, Zac Rogers will go over today with Zach Strickland. The LMI is indicating an enormous amount of stress and capacity and in rate, and that tells us that really shippers are starting to feel the pain. Again, this is a survey of shippers. And so it is inevitable that shippers are going to be paying higher rates. The fact that it's as much as 50 cents a mile, which represents, when you look at the average contract rate, it represents a significant increase, as much as 20%. And so when we think about what that means for the overall health of the freight market, is that it will return a lot of cash flow to motor carriers, particularly as fuel isn't seeing these huge spikes. Yes, we do have some conflict in Iran, and Hormuz is still a factor in a news story, but diesel prices have not moved very much in the last couple of days, telling us that probably the pressure in the diesel market, at least as it looks today, doesn't appear to be headed in a hyperbolic situation where we're going to see a significant increase in diesel. That is good news, because it means that high levels of inflation, high levels of pressure in the diesel market are unlikely to show up. And frankly, it means that fuel surcharges, something that really drive the contract market more so than anything, are not going to take away some of the opportunities for motor carriers to get higher rate increases. The way shippers look at this is the cost of fuel and the cost of line haul, and really their whole budget process is really a factor in how they think about it. When we see fuel prices drop, it does help contract rates, because as fuel prices go up, shippers' budgets open up more dollars available for line haul rates, and it's less pain for them. And so this is just something to keep in mind when we think about the market. Now, the question on everyone's mind is, how long can this process continue? Well, here's my perspective. This is definitely a compliance crackdown and regulatory driven recovery. That is indisputable. But what we're also seeing in the industrial side is a very wide level of recovery. And we know this because of the AAR weekly report. We had the CEO of the American Association of Railroads on yesterday for FreightWaves Today. And the information we were getting, they have their monthly report that came out yesterday as well, is the fact that this recovery across all commodity groups, except for coal, put that aside because coal is a little bit weak, and forest products, which is really related to construction, is very wide. It's expanding. That's a very good thing. In fact, in some of the categories, in fact, most of the categories were up double digits in terms of volume. When you look at how strong this market is in terms of industrial recovery, that is a really good sign for the broader trucking market and for broader manufacturing, because it means that manufacturing is coming back. And that's likely to mean that when we look at these commodities going into factories, that a couple months out, we'll see increased ramping of volumes of finished goods, which is exactly what drives the trucking market. So there's no reason to believe that this recovery that was driven really from a regulatory crackdown has any reason why it won't sustain. This is going to take us out. When we see the recovery in volumes and demand happening as we see the compliance crackdown, this is a very good sign for motor carriers. One of the other data points that I would say is we know that the Department of Transportation, the Federal Motor Carrier Safety Administration, is looking at market rate data as a sign of market health. They care deeply about the health of the freight economy. This is an unusual development. This DOT, this FMCSA, is checking on market conditions. They know how important it is. Sean Duffy's talked about it. Derek Bars has talked about it. Now, while they're not going to lean in and change the market conditions in terms of regulating price, they care about market health. They monitor it because they know that if you want a safe and secure supply chain and a safe and secure trucking market, you need to deliver cash flows to the motor carriers so they can make those investments. And so they look at market rate as a proxy or a signal for the compliance that they're instituting across the market. They are well aware that over the last couple of years, this market has gotten way out of hand. We saw an economic crisis, and that correlates highly to the security and safety crisis at the same time. And as you start to see improving market conditions reflected in rate, you'll see improvements in safety and security because companies that are operating profitably will be able to make the kinds of investments that they need to make to create a more secure supply chain. This is often missed by people who do not understand the overall mechanics of why the Department of Transportation, the FMCSA, care about that. They want a healthy trucking market because they know that if we have a healthy trucking market, that means we have healthy safety and security. And I always say follow the money. The ATA, I've been very critical of the American trucking associations for some of their positions, particularly on the quote-unquote truck driver shortage. The reason I'm critical about it is that they've missed the broader picture. The broader picture is by lowering the barriers to entry, we have flooded this market full of non-compliant motor carriers. But that's going away. You can see it in the ATA's conversation about the market. They want a tighter market. They want less capacity in the market. It's healthier for the overall trucking market to do that. And when we think about the safety and security crisis, these things are all aligned. In fact, if you don't believe there's a security crisis, go look at FreightWaves every single day because the top stories have something to do with some crime that's in the multi-million dollars. This party is going to continue. It's going to continue because the compliance crackdown is real. It's going to continue because the regulators care about the market health. This is going to continue because we're starting to see reindustrialization and a broadening of the industrial commodities, which tell us a lot, and I mean a lot, about manufacturing over the next 6 months. And all of that is good for the American trucking industry and overall market conditions. Now, when we look at the map, not a ton has changed in the past couple of weeks in terms of where freight is higher, which markets are outbound markets versus inbound markets, or head haul markets, if you will, or markets that are backhaul markets. The reality is that it is broadening a bit, and we can look here at the map and see exactly where it is broadening. Southeast, we see a little bit more blue in the map. Out west in California, we see a little bit more blue. That's import season starting to pick up, so we should see more imports over the next couple of months. The Midwest has always been hot, or at least been hot all year, and again, that continues. And we're starting to see a little bit of increase in demand and better market conditions in the Northeast, around New Jersey, around eastern Pennsylvania, which is really a sign of just the fact that this recovery This market map is expanding. I think all of that is super positive. We expect this rally to continue. There's no reason to think that it won't. And look, I'm as incredibly bullish as I have been.
All right. It's got me feeling optimistic and excited.
It should be.
That was a great update today.
There's no change in optimism here. I would say yesterday's rail report, the LMI, those are two. And we're going to hear, Zac Rogers, one of the authors of LMI, is going with Freight Economics with Zac Strickland to talk about what they saw in the LMI data. The rail data, again, I can't say it enough. It's an important indicator of demand. And look, one of the things to keep in mind is while we have demand signals inside of SONAR that are important for trucking, the rail data, because it's particularly in the bulk side, we had Ann earlier from the intermodal IANA. The bulk stuff is the most interesting because it's the raw materials that go into production and manufacturing. And it tells us that this is expanding, the recovery is expanding, and that is what's likely to happen in the trucking market. And this is ultimately means contract rates are going up.
Yeah, and I love 2 points that you made about that. As contract rates go up, motor carriers have more cash flow, and then they have more money to spend on things that matter.
Well, look, and the administration's paying attention. I know for a fact
they can afford to spend money on quality drivers,
correct,
on safety systems, on all of those things. And regulation is part of that, right? And tied into that, and regulation is helping boost the trucking market currently. The DOT signed with SONAR earlier this year. They want to understand market health. They recognize, rightfully so, that when you don't have a healthy trucking market, when rates are low, and it's not a healthy market, that is bad for investment of safety and security. They want to see the motor carriers, they want to see the drivers do well. They've said this, Sean Duffy said it at the Louisville Truck Show, which took place in March, just how important a healthy trucking market is. And really the proxy of that is spot rates. So they're looking at NTI every single day and understanding what it looks like so that they can understand how much investment is going into this industry, which I think really tells us everything we want to know about this rally. All right, so I got to say it. If regulators like DOT, the FMCSA, the White House are looking at SONAR to gauge market health, you should be too. We'll be right back with Chris Wofford.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Well, we are going to talk M&A. It is starting to turn up, just like the freight market. This is attracting a lot of new investors into the market. It's also attracting a lot of companies looking at consolidation. And to talk about it, we have the perfect guest. We have Chris Wofford. He's the founder and managing partner of Wofford Advisors, who helps companies understand what their value is, as well as a boutique investment bank takes them to market. Chris, welcome.
Thank you so much. Nice to be here.
So, Chris, let's talk about M&A. Last couple of years in trucking, it's been, it was a difficult time. We saw some private equity companies buy some trucking companies that didn't know what they were buying. Not a great track record. This feels different. We've got the buyers that know the market that are leaning into it. What are you seeing?
Yeah, I think there are some pretty substantial forces at work right now that are going to impact the market from a volume and dollar value standpoint in a pretty material way. The PE activity, both on the buy side and on exits, has been delayed largely because we've been in this really difficult freight cycle. And so if you think of it, you were just talking about the rise in freight rates. So, we've had a 3+ year malaise that has made the regular exits that would be otherwise taking place, particularly in truckload brokerage, delayed. And at this juncture, with the 50+% spike in spot rates year over year, we're seeing a real pivot in people's point of view on their earnings profile. And that, of course, that stability leads private equity that owns portfolio companies to think about exiting. And it leads more stability on the buy side so that we have more of a narrowing and joining of points of view on earnings streams. So stability and rising environments are obviously going to be very good for M&A volumes.
So, Chris, really, last couple of years, and perhaps over the last decade or so, logistics companies, third-party logistics companies, were much hotter. Valuations were much higher than asset-based carriers, which I think is it's absolutely the right move. I mean, that makes sense. What are you seeing right now? Are we seeing non-asset valuations increase? Have companies pulled back? Have investors pulled back because of the concern around Montgomery? What's the sort of state in the non-asset side of the world?
Well, look, I think that you've got different stories going on in different sectors. So your story in warehousing is different than your story in truckload brokerage is different than your story in air and ocean forwarding. So it's not a one-size-fits-all answer. But I think overall, what we're seeing is that there will be a rise in performance. We obviously, and just to sort of step back for a second, it's important to note that PE and EBITDA multiples tend to move in inverse relationship to performance. So we've done a bunch of regressions at my firm looking at the CAS index and other indices to show how in downturns multiples rise. So on one hand, you could say, well, there's been a pullback, but on the other hand, multiples are at kind of historic highs just because we're headed into a really steep earnings curve. And so I think what we're going to see is a volume of transactions are going to take place at multiples that are going to look really big today. And when we look at them at the end of the year, we're going to look back and go, wow, that was actually a pretty good buy when, 14 times on the buy side turns into less than 10 by end of year or a year from now.
Yeah, these businesses have massive operating leverage. I get asked this oftentimes on X is why does Knight-Swift trade at a 380 multiple and RXO at these very high multiples? It's really oftentimes people that don't understand the cycle. Like private equities had a mixed record. In every industry, they have a mixed record, but certainly in trucking, they've had a mixed record. We've covered a number of stories. We covered one yesterday. It was a private equity firm that had a non-asset business that bought into an LTL provider and it went under. They decided to shut it down. Is this an environment where private equity should be looking at assets, or is it an environment where, and really in all environments, should they stay away from it?
High capex businesses that are cyclical are not particularly healthy to lever up meaningfully, right? So it depends on the private equity source. Some private equity firms are going to try to top out leverage. Others take a much more modest approach. And so it's not a one size fits all, but I certainly don't think highly levered asset-based trucking companies are the way to go in terms of stability of performance and returns for shareholders. I do think that there is a need for capacity and access to capacity that exists amongst the asset-light players. And so I think there is going to be an increasing convergence around selected assets. And we've seen that with Hub, and we've seen that with some of the trailer leasing programs that have been underway. And so I do think there's a convergence theme there. Does that mean that we're going to see a big merger between a truckload broker and a carrier? Probably not. But I do think that that's an interesting dynamic. Hub is probably one of the closest to having the mix of assets and asset light in terms of public companies today.
Yeah, and it's gotten, anytime that you have accounting, not filing earnings, you have, that just creates overhang on the stock, which creates opportunity, frankly, for the right set of investors, maybe able to ride that. Forward Air is also another name. I've talked about that. Amazon has rolled out its LTL business. Like if I were Amazon, I'd be looking at Forward Air because you can get it at a substantial discount. It's got some balance sheet problems and perhaps overpaid, or the Omni merger was quite messy, but it feels like that's an asset that should offer the right buyer, and Amazon feels like the right buyer for that expedited LTL business. I don't know your thoughts on that.
Look, I think there are fundamental questions about what Amazon's LTL business is going to look like when it's fully rolled out. And there's no question that Forward Air, Omni to the side, Forward Air was an outstanding operator, but it's, of course, a wholesale provider to other 3PLs. It's the underbelly of capturing an air freight rate when something's moving by ground. So it's an excellently run company. Amazon does have a history of going in and analyzing excellently run companies and figuring out how to do it on their own rather than necessarily needing to work through acquisition. But I think the jury's out on what Amazon's going to do next. I do have a few. Sorry, go ahead.
No, go ahead.
I was just going to say, I do think there are a couple themes that are important for your viewing audience to kind of have in their minds as they think about this coming M&A cycle. And I think there's two really big drumbeats that I would just emphasize with you. And one is the way that boardrooms really needed to reassess their supply chains during COVID. And I think you've got a delayed strategic response to COVID that's playing out now in some important transactions, like the recent FedEx divestiture of logistics to what's going to become part of CEVA eventually. And I think you've seen the same with Nippon Express coming into the U.S. And Canada through Metro. So there have been some moves that are all about controlling the supply chain globally, which I think are going to be an overarching theme as we keep rolling from 26 into these next few years. It's been really kind of unstable to make big strategic moves until the recent past. And then I think the other thing is that we've got the resumption, which we just talked about, of the private equity activity, both on the buy side and the sort of historically pent-up amounts of capital that need to be deployed and the exits that need to be realized. And so you've got two really strong forces. Even if we're not in an environment with low interest rates, we've got two really strong forces that are going to be driving momentum, particularly as this rate cycle continues to play out. So sorry to move the topic on you, but I think that that's an area that would be really interesting to explore.
I mean, Chris, when I think about the truckload environment, which has historically been a really, my family knows this, I know this painfully well, about how brutal and unforgiving the truckload cycle can be. We have argued, because of the regulatory compliance crackdown that's happening, that we could be entering a trucking super cycle. The data suggests that we have the setup for that. Especially the economy, if we start to see more demand come in, which we've talked about the industrial economy doing well. Do we see an environment where a trucking super cycle makes these asset-based carriers more investable, that perhaps we can see more consolidation? Because that's been the dream of every asset owner, is the idea that we're going to see a mass merger, a mass consolidation. It's not happened. In fact, the opposite. We've seen a mass fragmentation. But it does strike me that if we get a super cycle, these assets become far more attractive in that kind of environment.
Yeah, I think that's very on-point thinking. There's no question that there are some really finely run companies. And by the way, I've been doing this for a long time. I used to work with your dad decades ago. So I'm hearing you on the cyclicality of the space, but there's always going to be a room for sort of supermarket models and specialty stores. And that's, if there were one theme that we have when we talk to our clients, it's about the barbell of where transport and logistics is heading. Now, I think that means there will be more consolidation amongst the very large players that are playing in. If I say more commoditized, I don't mean that in a bad way. I just mean it's not a niche offering like, hey, we move fresh flowers or refrigerated pharmaceuticals.
Truckload is a commodity. And like for the folks that are in denial, they need to get with the program because everything's rate driven in that high volume truckload market. We all know that. So you're aligned with us here, Chris.
Yeah, look, I think this is a supply side bump, and I think it's a sustainable supply side bump. And then I think the question is going to be, how does demand accelerate that curve? And so I think there's every reason to believe that there are the basics for consumer demand and industrial demand that's going to continue to drive. And if that demand cycle hits the supply constraint that we're experiencing, I agree there's a super cycle coming.
So we've talked about asset-based truckload and we've talked about brokerage. So obviously the UP-NS merger looming over the entire rail sector at the moment. Do you think that's going to shape M&A in some of the other industries that touch that? Drayage, railcar services, transloading, all of the things around that industry?
Look, I've been doing M&A for 35 years and transport M&A for 25. And we always dreamed about the big rail consolidations, right? That was always viewed as a little bit of a pipe dream. And I think we've come out of a really tough regulatory environment for large deals and strategic combinations and entered a good one. So I think there was every reason to explore that transaction in today's environment. And obviously there's all kinds of synergies and economies of scale and creating a greater network that are material. Now, does that necessarily trickle through that you need to have large-scale providers on drayage? I wouldn't say so much. I think drayage continues to be a relatively fragmented market. Are there opportunities for drayage to be part of a bigger suite of services? I mean, Julie, one of our key themes is about owning the customer. And so we're really focused on how do you control different parts of the customer's spend. And I'll just pause for a second and say that hasn't always worked in the past because you had different cultures within some of the different institutions. Like CEVA for a long time really struggled because the air and ocean brokers had a very different philosophy from the warehouse operators. But despite how that may have not succeeded in the past, I think we anticipate an era where the bundled offering and really serving all the needs of the customer under one umbrella becomes a strategically important asset. And I think that all the technology that's rolling out right now, I mean, if you back up, we're going through a once-in-a-generation change in technology that very much mirrors the late 90s. And I think you guys have had that on your program. I was actually a telecom banker in the late 90s doing large combinations, Quest US West, and things like that. And in that era, we were laying down the pipes and then trying to buy the customers to put on the pipes. And today, I don't think that we're looking so much at our different logisticians laying the pipes. The modes by which they deliver are going to change, and that's going to hit every industry, rail included. But I think the question becomes is, how do you control that customer? And control may be the wrong word, but how do you own that customer spend? And I think the visibility tools and intelligence that are coming out of all the moves, truckload brokers moves, warehouse moves, how's the inventory moving, where's it procured, those become strategically critical to all the large industrial customers that are out there. So I think there is a really big theme at work that we talk to the public boards that we deal with very actively about. So how that relates to rail, looping back to your question, I think there'll unquestionably be some consolidation. But I think drayage, for example, will continue to be relatively fragmented, which was, I think, your specific ask.
So obviously truckload as a whole, incredibly fragmented, but you've spoken to consolidation here around the railroads and some other sectors and to this multimodal consolidation happening. Is that something that you think is going to be dramatic enough to truly change the competitive landscape in our sector and in the transportation?
So here's what I put your eyes on, and I think, we're keenly focused on it. if my analogy is right, that the technologies that are rolling out today are changing the fundamentals of how goods are being delivered and how goods are being monitored and tracked, I think that do I care whether an autonomous vehicle delivers my parcel? Do I care whether it comes by drone? Not so much. I just care that I get my parcel and I know when it's arriving. And so I think that the technologies are going to change the methodologies by which the world operates. And I think 5-10 years from now, we'll look back and it'll be a very different picture than where we are today. But the important part is owning that customer, right? Fundamentally, how do my needs as a consumer get met, or do my needs as a retailer, wholesaler, or industrial manufacturer get met? And so I think there's just going to be a fascinating consolidation of service offerings that's going to take place because of the value of the information to the ultimate customer.
So, Chris, I got to ask from a sort of an interest level, activity level, what's hot, what's not?
What hasn't been hot has been intermodal, but I think that's going to pivot as truckload rates rise. We were working on the STG workout, and I think we'll look back at that in time and say, wow, that was quite an opportunity that was missed by the marketplace. And kudos to the team there for executing on the turnaround that's underway. I think that's probably been one of the sectors that's been least hot. I mean, truckload itself has been tough. We represented Werner on their recent acquisition of First Fleet, and that was an important move to push them up to being fifth in dedicated in the U.S. And I think that was very much on the front end of the truckers, as we talked about earlier, coming out of their doldrums and being relatively hot opportunities. And particularly to your point about the super cycle, they've got a great chance to capture immense OI going into this in this next earnings wave. But I think asset light, it's really hard to turn your nose up at some of these great companies. I think, Drew Wilkerson, we're going to look back at the Coyote deal, and even though he's gone through a really tough patch, I think he's created something of great scale. And when he gets his leverage down, I'm sure they will continue to be active as they have been in the past. So, I always tend to look at those big logistics names, and I think there's a lot of excitement and sizzle there.
Yeah, I think, RXO's got a huge opportunity in the second half because, as you said, they bought, the timing on Coyote was difficult. They bought it. I think we all thought the market was going to come back a little sooner. There's a humbling scenario. Really appreciate it, Chris. We'll have to have you back, give us an update as we move into the end of the quarter because there's a lot of activity, I suspect. With all of the noise in the market, with all of the transactions in the market, there's going to be a lot of deal activities. It's a great time to be opportunistic and freight.
Thanks for having me, Craig. It's great to see you, Julie. Appreciate it very much.
Appreciate it. Thanks, Chris. That is the FreightWaves Today segment. Stay with us. We have Freightonomics with Zac and Zac. We have Zac Rogers to talk about the LMI. So if you're interested in diving into that, there's no better person than the author of the report to tell us exactly what they're seeing in supply chains. Stay with us.
In today's supply chain, every mile and every minute matters. Shippers, lessors, and railroads count on performance they can trust. That's where Trinity Rail delivers. With integrated railcar solutions including manufacturing, maintenance, parts, fleet management, and leasing, helping you reduce downtime, optimize your fleet, and stay ahead of demand. Because efficiency isn't a goal, it's a competitive edge. Trinity Rail, built to deliver.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
Huge thanks to today's OTR sponsor, again, OTR Solutions. They believe the right partners should know your business, understand your goals, and be there when it really matters. It's no accident that OTR boasts 4.7 stars on Google. They know that excellent customer support is at the center of every relationship. With responsive teams, industry knowledge, and a commitment to long-term growth, OTR gives customers more than service. It gives them a partner designed to help their business succeed. Learn more again with OTR.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right. Welcome, everybody, to the suited up version of Freightonomics. I'm Zac Strickland, head of Freight Market Intelligence here at SONAR and FreightWaves. And today, of course, we're going to have the illustrious Dr. Zac Rogers on his summer vacation. I think he suited up for us as well to keep things nice and crisp for the summer. So we appreciate him doing that. But first things first, let's get into a little bit of some high level, because I'm going to ask Dr. Z, because he knows economics as well as anybody. I'm going to actually ask him to come out here after the Market in 2 and dig into some of these topics before we break down the LMI. But first things first, I want to get the Market in 2 out of the way. You've heard Craig talk about the market for a bit. Get a new fresh perspective from me, which is not going to be terribly different, but still might have a few tidbits in there for you. All right, guys, I'm going to count myself in. 3, 2, 1. All right, first things first. I get asked this so many times. What is the indicator you need to look at to navigate this market? The tender rejection index is absolutely the best one to look at in this market. You know, we talk about this whole dynamic of which one is leading the market, supply or demand. It's always both. The tender rejection index is really the end result of that supply-demand curve equation. For those of you that had Econ 201, you'll know what I'm talking about. So this is the net result. So when rejections go up, that means that demand is below supply. The supply of equipment, is above the supply of equipment in this situation, where we have over a 16% rejection rate. Normal market conditions, somewhere between 5 and 7-ish%. So we're in a tight space. You can see the historical values down there on the bottom 3, the last 3 years preceding this. So we are in a pretty big market turn. Let's go to the next indicator here. Spot rates, of course, this is the traditional indicator, but spot rates are noisy. There's a lot of other stuff going on inside of a rate. Anything that's measured in dollars, there's other things going on. As a former financial analyst, I can speak to that clearly. You've got cost fluctuations network. You've got speculation. Look at the WTI that we'll talk about here in a little bit. A lot of other things are going on, emotion that move this, but we do have a lot of correlation between the tender rejection index. We've got the van, flatbed, and refrigerated versions of this, all of them moving up and to the right. We're plateauing a little bit this summer. We'll see what happens next. STVI is going to be the next one here. This is a demand side indicator. You see demand is up year over year. It's just not up the same way that we've talked about this in the past with other market turns. So it's still fairly good. Robust economic signals here. Not much going on, not much to see. The last chart I want to bring up up, the contract versus spot. This is the most interesting one to most people. Contracts on their way up, spot rates way above contract rates in our indices. So, I mean, that last chart, when I've talked about it in the past, anytime spot rates, which are the rates that are negotiated on the daily. So they're basically giving you a quick, what is the value of transportation capacity today type measure. And they're well above that long-term contract rate. And contracts are normally set around 12 months. Of course, in markets like this, they can last for 2 months or a matter of weeks if we're talking about COVID. And that's hard for people to digest that don't come from the space. Because if somebody is calling you trying to buy a widget that you normally charge $2 for, and then they call you and say, you know what, I'll pay you $10 for that widget. It's hard from a business perspective to say no to that request. And that's what drives the spot rate up quickly. Now, most of the time, the spot market is very volatile and it bounces up and then it comes down just as quickly. So it's not super long run in most situations. Now, in the market conditions we're in today, we'll see how long this one lasts. It looks like it's going to persist for a while, especially as inflation seems to have taken a pretty big step up over the last bit. So without further ado, I want to bring on the man, Dr. Z, and see, because we do have some economic stuff that's been coming out over the last few weeks. I want to get your take on this, Dr. Z. Like the labor market stuff fascinates me because I think it's a little indicative of the economy itself. It feels like it's in almost a holding pattern. We've talked about this, I think last month we alluded to it a little bit. The economy's not like bad, but it's almost like we're, people like you and me are thinking like this could be better. And it's almost like we feel like it should.
It definitely could be better. This is I think we have a high potential economy, but it's not, we have these constraints that have slowed things down. And I think absolutely the labor market, if you look at the added 57,000 jobs last month. And then we also saw revisions downward by, I think, like 70,000 jobs in the 2 months previous. And so we are seeing still some softness. And you know what I thought was very interesting? Is if you look at where the jobs are being added or not added in supply chains, even though we have this high tender rejection rate and all this stuff, driver jobs are barely moving. I mean, if you look at over this year, we haven't seen a lot of movement in transportation jobs. We're almost at break even. It's very much no hire, no fire. I mean, April was big, but then we had negative and, for the other 5 months but then warehousing's been pretty good. And it's an interesting dynamic. And one of the things that I think we're seeing there is that we have seen really a big pull forward in the beginning of the year, upstream sort of manufacturing side. And then now clearly the heat is on retailers because, they were going slowly and consumers just keep showing up. And so now we have to pull things forward. Not only are we pulling forward, stuff for later in the year because we got to talk about 301 tariffs later today, I'm sure. But they're also pulling things that maybe should have came forward earlier because, hey, it looks like back to school is going to be pretty good. And NRF says, 32% of consumers are already buying back to school stuff. Right. By the way, if anyone's wondering, I'm in the 68% who have not. So there's all this movement. And I think it's put a lot of pressure on warehousing networks and transportation to me. And you talked about emotion, which I think is totally there. This is such psychology. I mean, it's really like won't get fooled again, I think, with increasing transportation capacity where right. I think people don't want to see a repeat of what happened with, the freight recession that we just got out of was so bad because people jumped at those, that nice green line you showed a minute ago with spot rates up so much. People jumped to build capacity. And I don't think we're seeing the same movements now. And again, it's because of the level of uncertainty that we have in the economy with things like, well, our tariff's going to go up again next month. Is the Strait of Hormuz really open? There was talk about putting 100% tariffs on the EU and embargoing companies. And so I think it's really hard because if you look at that green line, that screams out, if you're a carrier, we should maybe add some capacity because times are good, right? Demand is up. Let's bring supply up. It's like the most basic economic principle there is. But no one wants to make that big investment when we still have the level of uncertainty that I think we're dealing with right now.
And I that's kind of the point of the labor data to me, is that we're seeing this economy that a lot of people, I think, were already uncertain about last year. We entered this year and the tariff ruling kind of repealed. I mean, most of the companies that I talk to are kind of like, we just don't have a clear path forward on what to do with some of these procurement practices. We can't nearshore, we can't offshore. We were doing China plus one after COVID. That's a 3 to 5 year plan build out that we don't want to get caught. Just think about a few years ago how EVs were being incentivized by the government, and all those auto manufacturers basically got left without this subsidy. And I'm not going to get into subsidies here, but at the same time, like, I think there's so much movement, there's so much dynamism in the economy itself. Geopolitically, obviously, we have the back on again conflict with Iran, that a lot of these businesses are just kind of in a holding pattern. And I think that's reflecting through the jobs market data relatively cleanly. And again, it's not like recessive. And I think we're stuck in this mentality of things have to be either great or terrible. But I think we're ending up with this net result of just things are just moving along, and people aren't trying to take those big chances for later in the year, kind of like you said.
Yeah, no, it's like we're playing, 1950s football. It's just 3 yards, cloud of dust. No one's going downfield. No one's taking any chances. It's very conservative. It's like, all these 0-0 World Cup games. I mean, things are happening, I guess. Yeah. And so I think that's very much the case. I mean, one clear source of uncertainty is, the USMCA expired last Wednesday. And Mexico and Canada are our two biggest trade partners by far. Now you could make a clear argument, and I think the data is there that, gosh, it's interesting that, we've gone up 20% with Mexico, and Mexico has 20% more imports from China. I wonder if there's a correlation. I mean,
and they did take over, I think electronics actually took over autos as the top, trade value component coming into the United States for the first time. Was it last year or early this year?
Yeah, exactly. And so I think that level of uncertainty just makes it difficult. I mean, because what we would like to see, and I think what companies were expecting once we got, maybe softer Fed policy was, okay, that we've been keeping our powder dry on CapEx, and now we can really make these moves. And it's tricky because, one of the ideas behind the tariffs was let's incentivize, some nearshoring and even reshoring. But if you don't know what the policy is going to be, you can't make that investment. And if you don't know what monetary policy is going to be on top of that, and then energy prices, it's just there's, remember when you would be in like algebra in 10th grade and you do 3 equations, 3 unknowns? That's too many unknowns for big investments. You're right. Companies are fine to solve for X, but if you also have to solve for Y and Z, I'm probably not going to spend, unless it's a data center and I'm being subsidized, I'm probably not going to put in, there's one thing, but I'm probably not going to put in, a big CapEx expenditure if I don't know all the variables.
That's actually one of the best nuances to call out in this economy. And I listen to CNBC quite a bit in the morning, and they are like, what's interesting here is that these data center build outs, anything involving AI build outs, are immune to interest rates and inflation, the two things that are keeping the rest of the economy kind of in a holding pattern. And it's because there's so much ROI potential in the investor. Anybody that's dealt with VC knows that all the return is on the back end and it's years out. So they don't care about a 0.5 point interest rate move here and there, or a 3% inflation figure. That doesn't really move their needle in the context of like the $1 billion returns that they're expecting later.
No, they're air freighting construction materials, which is, not the most efficient, cost efficient way. It's going quick. And so I think that totally speaks to, you see everybody else trying to pinch pennies because of fuel costs, and data centers are, we're flying stuff over on planes, because spare no expense. We just got to get them up.
Yeah, and it's pennies on the dollar in terms of a total cost anyway. So they just need to proceed. Like they want to get to the point where they can start the process of generating return. There is one question economically that I want to ask you, and this is one that I can't really reconcile. The labor participation rate has been plummeting. I mean, and it's not a huge figure, but it is like in the context of this chart, you can see that over the last, several months, and this last rate of change, I see this debated all the time, and I'm very curious as to some outside insight here as to what this rate of decline means to you, because this is partially what's keeping that unemployment rate low, as nobody's hiring or firing. I just don't know what to make of this figure, especially the rate of change here recently.
Right. The slow growth of the numerator of jobs hasn't mattered that much because of the denominator is shrinking as well. And I think there's a couple of things. I mean, one, you would have to say immigration has probably played some role there. The net flows of immigration are down quite a bit. The other thing is we talk about all the time at universities, demographic cliffs. We talk all the time about the demographic cliff, and people didn't have as many kids, as the last generation did. And there's really, I had a coffee this morning with a guy who's about 70 and was a VP at one of the companies that we work with a lot at Colorado State, and now he's going to come help the students do nice stuff. But his firm and a bunch of other firms around here, at least, have just done huge buyout packages basically, and we're actually seeing maybe it's just anecdotal to where I am. I've seen a big exit in the last 2 years of that sort of baby boomer generation, right? That's right up at the top of a lot of companies. Partly they're more expensive. We're transitioning things to technology. And then at the same time, the groups coming up, the student groups and some metrics are getting smaller than they had been. And so I think part of it is honestly like macro demographics.
Interesting.
That's changing a bit. And I also think you have more folks now who are maybe off grid in some ways, like people who are doing gig work or things that it's harder for us to track. I think is a piece of it too. But if I was to sum it up, I'd say that the rise of so much gig stuff where it's sort of off the books. There's so many ways to make money now. I don't know how we count the YouTube streamers over at the Bureau of Labor Statistics, but it sure seems like there's a lot of them. The demographic shift, I think, with baby boomers really starting to exit the market more, and then immigration. I mean, the reason that the low, and this is now getting into so many different demographic statistics, the low birth rates in the U.S., which I think we have to be at 2.1 births per woman to be at replacement level, and we're at 1.6 right now with native-born U.S. women. The reason that hasn't affected us as much is because we've had heavy immigration flows, and now we don't. And so I think that's one of the other main things that's hitting that denominator, which again sort of minimizes the impact of low job rates, because it also minimizes the need for more jobs. Now, long run, you want populations to go up because you want people to buy stuff, and more people here, I think, also means more innovation. I mean, look at all the big companies, NVIDIA, Google, Amazon, Tesla. Those are all, immigrants or children of immigrants who started those companies. And so I think you want some of that in there as a job creation engine. But that would be what I think. And I know this is not freight talk, but that is why I think we're seeing the jobs.
I did have a point there to bring this back to freight, because one of the things that I've encountered in the space in my numerous conversations is that recruiting for jobs has become increasingly challenging, especially in the driver population. So that capacity growth issue that we're talking about, and I'm talking about across the space, larger fleets, smaller fleets, same situations. I know immigration is a little politicized, but at the same time, it's real. But I think my thought there is that if the economy were to turn up or turn on, I think that this is going to be a longer term mechanism that's going to inhibit some of that growth. I mean, I know that I've talked to several people about construction, and, they can't hire a construction worker that's not working on a data center or something involved there. And that's kind of keeping a cap on some of these build outs. So if the housing market were to suddenly turn back on, that's going to be limited or constrained by labor. And I think we're going to see something similar in freight. Like right now, you said it yourself, like spot rates kind of suggest, hey, now's the time to get in and get paid. But if nobody's available, that's going to slow that potential growth. I think I did a mini study, kind of napkin math-esque, on what the rate of change in supply of capacity is on any given cycle turn. And it's roughly 1% max. And that's when things were less regulated and immigration was a thing and all these other things were in place. So I feel like we're going to have a deceleration in that supply side moving forward that might keep things a little bit higher for longer.
And there's two things, right? There's two things you need for real economic growth. And by the way, the reason the U.S. recovered, so everyone got hit with inflation right after COVID in 21 and 20, especially 22. The reason that the U.S. bounced back faster, even though it didn't feel that fast to us, the reason the U.S. bounced back faster than everybody else is because we had the two things you need for economic growth: energy and labor. That no matter what it is you're doing, you need energy, you need labor. In 23, in the end of 22, but 23 and then going into 24, we produced more energy than we ever had before with natural gas and oil and all that stuff. We also had like 6 million immigrants come in. And so that burst of labor and that burst of energy is what fuels real economic growth. The reason we came back faster than even China did is because their population is getting older and ours was not getting older as fast. And so, the problem with that is, and again, I wish it wasn't political to say we need more oil and more immigrants, because by the way, there is no political party that thinks that. Right. One thinks we need one thinks we need the other one. If only there was if they had like some sort of Congress, they could come together and, talk about these things. But
that feels rational. I don't know what.
So the other thing that I'm to get back to what we're talking about, I do think that labor is a constraint on potential growth, and so is energy. We've seen energy costs really go up. I mean, you saw this morning probably Russia, because their refining capacity has really been hit because of this conflict they're in. Right. They're not doing any more diesel exports in the near term. Wow. And so diesel futures went up by 11% this morning because of this crunch on energy. And we already have the crunch on energy from Hormuz. And so the things that I think are truly holding back the economy, besides the uncertainty and the tariffs and all that, like you said, there's clearly opportunity there. The contract market is up. Anytime transportation is up, that means we need to move stuff, and we need to move stuff when there's economic activity. And the two things holding it back right now, I think, at least in the United States, and is the constraints on labor, and then globally, the constraints on energy. And so it will be really hard, I believe, to fully unleash the potential of the U.S. and the global economy if you don't have adequate energy, which we need more of, by the way, because of all these data centers, and adequate labor.
And water too. So there was a
hey, shout out to Anthony Smith, by the way. I'm going to drink some water right now.
Yeah, drink more water. I'm sure he's well hydrated down there in Texas. But John Kingston writes these weekly pieces. He's been writing more of them lately. He's a brilliant oil market expert. He comes on FreightWaves today, Tuesdays, I believe. But he wrote this last article, which is fascinating to me. And there's been this ongoing back and forth, and we have about a minute left till our first break here. We have breaks now, Dr. Z. Hey. But he wrote this piece about like the crack spread, about the differentiation between like oil, crude oil, and the derivatives of the oil prices, and how they have gotten to all-time highs here recently, because the price of diesel hasn't really followed the price of WTI lately. Over the last month or so, we've seen this disconnect. And if you look at this chart here, you got the ULSD, well, that's the WTI right there. It looks fairly similar in shape, but if we were to line up WTI with that gray line, we wouldn't it actually, diesel's been more flat, whereas WTI's come down based on speculative behavior more than actual like physical inventory. And I think this is a fascinating topic. And I've talked through where I'm not going to give you enough time to talk into the break, but after the break, I'm going to give you, I guess, a minute or so to think about this question, because I want to know your take here as why and how people should think about this inventory being continuously drawn down, but the markets themselves are signaling the opposite. So it's an interesting conundrum. You got shippers, you got carriers, both purchasing directly and indirectly. I want to know what you think. We'll be back after this quick break.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right, coming back from the break, I led you off with, or I left you off with a question around this price of fuel / diesel coming down, not necessarily connected to the underlying crude price all the way, but inventories have been diminishing. And it feels like this is kind of an artificial, or it's not a sustainable movement, especially now that the conflict has been renewed for some period of time. Looks like this could change tomorrow. But how should people think about this if inventories are threatened that much and the markets aren't signaling it? What do you do here?
So, by the way, that was exactly enough time for me to read John's article. So, great job with the commercial selection. So, I think it's a couple things. One, I do think you have to keep it in perspective when we say like, oh, prices, are moderating. Mm-hmm. If you look at the EIA numbers in the United States, a gallon of diesel is still up 84 cents from this time a year ago. And, you know, if you go into specific markets, I mean, it's more than $1 up. I mean, in California, it's $1.18 up from where it was a year ago. So yes, it's down maybe 80 cents or, you know, from where it was in April when things were really bad. But it's still not really like what I would call low or regulated. So that's one thing I think to keep in mind is that, you know, it's almost like a change index where it's still expensive. It's just not getting so expensive so quickly. So that's part of it. Yeah. The other thing I think is that it's difficult to see physical inventories. Like it's very easy to see the cost of oil coming in and you look at the gas station, you see the prices up. That's very easy to see. I don't really have a great conceptualization of, you know, our strategic oil reserve on just a day-to-day. I mean, I think about it, but you know, I on a day-to-day basis, I'm not thinking about that often. And it's sort of like, what I think is that we've been allowed to sort of coast on our savings, especially China, by the way. And China is the one who, in terms of imports, is hurt the most by Strait of Hormuz, probably. Right. And they've been able to sort of coast on their savings for a little bit. And it's sort of been out of sight, out of mind. I mean, I think, you know, if you're in the US and you're thinking, well, we're getting goods from China and they're not getting as much oil, like it's sort of, we don't think about our supplier's savings account because it's sort of psychologically distant. It's removed by both time and space. And so I think that's part of what we're seeing. So I think the two, I guess to sum up what I think the answer to the question is one, prices are down, but they're still actually very elevated from where they have been. And two, the real drawdown in inventories, which is important, like we are burning through our savings, seems far away. And I think people aren't taking it into account when they're setting these prices. And probably third is, you know, traders are optimists. I think there's a hope. And you know, we saw 76 vessels go through the strait on one day a couple weeks ago. Yeah. I think people are really hopeful that things are going to open back up in time, because I think there is a feeling that politically it would be difficult. You know, this is a midterm year in the United States, and I think it would be difficult to go into that with, you know, gas prices and energy prices way up and trickling into goods. So that would be what I think is happening. It's fascinating though. Yeah.
No, the oil markets are amazing, and John Kingston is one of the best at, I mean, he's got more oil knowledge in his pinky than I think I have of anything in my entire head. So one of the reasons this is important too is that it's kind of this thing that's obviously driving the inflation figures. You've got this energy cost that is inflated. And we're not just talking about in the United States, we're talking about globally. We are in a global economy, whether we want to be or not. And a lot of our stuff comes from China. I mean, that again, I'm trying not to be political here, but these are the issues that a lot of people deal with. And we're not going to solve the politics of things, but I am trying to help people understand the context with which they are operating. And a lot of these things do have political motivations, as you said. And so a midterm year does mean that there is a motivation politically for them to do something about it. Because clearly inflation is a big headline figure, whether you think it's the right way to measure it or not. I personally have been struggling with, how we've handled inflation for years now. I did not love us raising interest rates, the speed that we did it after the COVID supply chain crisis stuff. I thought that was a little too aggressive. I thought that was also, there's no one thing that you can do that controls the economy that much. Like it's also a very slow mechanism traditionally. So,
I don't think, by the way, that we should raise interest rates right now. No. Even though we see inflation, going up. I think
that's not going to solve the oil shortage.
Look, I know I've talked about this before, but if people who want to understand this, Adam Shapiro, San Francisco Fed, breaks down where inflation comes from. Is supply driven or demand driven? Most of our inflation right now is demand driven. And so if you increase interest rates, most of our inflation is supply driven, rather.
Yeah.
if you increase interest rates, that doesn't make supply more available. It actually makes supply less available because you're going to have less investment from companies. And so right now, I'm not saying we should lower rates, but I would be very, I saw about half the governors in the last Fed meeting like, probably going to have to raise again because of inflation. But that, all they have is a hammer, so everything looks like a nail. But supplier-driven inflation, it's not a nail, it's a screw, and unfortunately they don't have a Phillips. And so I think that is, I hope we don't raise rates again. Because
I don't understand why we would.
It's not going to do anything to solve supply-driven inflation.
Also, the one thing that's driving a lot of the demand part of the economy right now is AI. And like I said before, it appears to be inoculated to any interest rates or inflationary processes in general. So why would you stop everyone else, which nobody else in the economy really is showing any signs of life? The one, before we get to the LMI, because I'm bad at managing time and getting to the thing that I want to talk about the most, but the ISM has been, the industrial side of the equation. I mean, Craig talks about this on FreightWaves today a ton. The rail carload data has been super robust over the last several months. It looks like, we're getting some manufacturing rolling, and you're looking at the ISM PMI, new orders and backlog of orders, all showing expansionary. The above 50 readings that you guys like to produce over the last several months now. So we've got, 6 months of growth or expansion in the industrial side. I want to get your take here on what this means to you and if you've parsed this out.
I do. Now, partly what we're seeing, I do believe, is a bit of a pull forward for components. We talked about how fleets have been slow to add capacity because of what happened in COVID. And I think partly what we're seeing is manufacturing is very scared to not have components, because that is kind of what happened when we ran out of semiconductors, all kinds of stuff in 2021. And so I think that's part of the reason behind all of the new orders going up and the investment, because if you parse it out and you look at employment, what's interesting to me is that the ISM has not reported growth in manufacturing employment for more than a year. It was the highest it's been in a while in June. It's 49.7, which is just about break even. But it's not. You would imagine. We talked about the importance of labor a minute ago. You would imagine that if we were going to see a big push forward in domestic manufacturing, that one of the things in addition to components would be labor. And so what I think is happening in some ways is I think manufacturers are, one, they don't want to run out of critical components. And again, I can't stress enough, switching from the 122 to the 301 tariffs. The 301 tariffs, is sort of like the way around what the Supreme Court did in February, which everyone sort of knew was coming.
Right.
And so I think manufacturers are worried that we could see prices go up again. And so I think some of this pull forward is because we're in a little bit of because with the current tariff regime, we're basically at 10% everywhere.
Right.
And who knows what it's going to be at the end of July. I think July 24th is the day that sunsets, and we'll switch over to 301. And so to me, I think one of the other pieces there, I do think there's energy in moving manufacturing to the U.S., but that negative employment makes me think that the investment in new orders is more of a long-term thing than it is a short-term thing, and it's a lot mitigation against future increases in cost.
Yeah, it feels. It's good. It's positive. We're getting momentum in that sector. And I think I was expecting it to kind of moderate a little bit here in the last couple of months, but it hasn't, because I thought inflation would have a little bit more of an influence on some of that. But it seems to be going quite well, especially considering the past several years of history. But I want to get to the LMI and talk about, first thing I want to talk about is inventory levels, because you've been talking about tariffs, and I want to make sure this, obviously we're exiting or right at the end of the review period for the 301s. So everybody can comment on them. And it's still kind of, you have to have these studies and all these things that go into place that, support this. And I think some of the critics of this policy or the way this is going is that, hey, you're still not solving the main issue here. If you want to have tariffs, it's fine, but go through the channels that make it clear, such as Congress, which again, the argument against that is that Congress doesn't agree on anything. So you know that you don't really have that option the way you want it. So what do? You go through the executive channels, which don't really have a more sustainable sense to them. And, you know, even if they go into place, people are just not sure how long they're going to last. We've got how many $100 billion sitting in, you know, coffers that are getting refunded as we speak. You know, it's a clunky execution from my perspective, but you know, we are seeing, if we look at inventory levels here, we see that they popped up in June, and this was somewhat of an expectation, I think, as the tariffs got announced in early June sometime, or possible tariffs in early June. It's only like a 2.5% though on top of what we already have. So I'm curious, did you see do you think this is pull forward on top of that, or is this something else?
I think there's two things happening right now. So overall inventory levels went up to 60.5, which is anything about 60. Now you're getting to robust levels of expansion, because again, 50 is break even. So 60 is pretty good. And really, it was driven by a couple different spots. One was our downstream retailers. So our retail respondents registered in at 66 for the buildup. And so I think that's really because of two things. So retailers had been the most cautious this year.
Right.
The pull forward that we just talked about with manufacturing and the ISM, we mentioned the ISM numbers have been up for a few months.
Yeah.
And that's why there's been some of the strength in intermodal. And so, you know, the manufacturers kind of got a jump early this year on, I think, pulling forward inventories. It's the retailers that were really scared, honestly, because last time we saw gas prices shoot up the way they did this March was in 2022. The customer did not show up. The retail customer did not show up in 2022, and you had all these big retailers doing huge write-downs. And so everyone was very careful in the early part of 2026. We really saw that start to shift kind of at the end of May, and then really going into June. You keep seeing consumer spending numbers like, up another 0.9% this month. And you know, that goes down to maybe 0.7 if you take gas stations out, but still that's growth, and consumers are showing they're going to show up. And so now retailers, in some ways, it's the same situation that we had with when you see that trucking line go up, the spot rate going up, and it says, well, gosh, we should probably jump on that. Retailers are seeing consumer spending stay strong and thinking, well, we should jump on that. And so I think there's two things happening. One is the consumer is more robust. Which is good news. The consumer is more robust than we thought they had been, and I think that's causing retailers to stock up a bit. Also, 301 tariffs, right? We've known now, we've had some lead time, so you would expect the imports to be hitting the shores now. I mean, we saw imports, you know, dock activity in all the U.S. Imports were up about 8% year over year in June. It's going to be up again in July. I think it's, you know, maybe 3.5-4% up projected in July.
Well, let's pull up the IOTI, guys, in the background there. The IOTI, I think I had it buried in the chart somewhere, but look at that, Wild Doctor. There it is. I mean, we saw this increase in bookings activity in early June. And like you said, these are landing now. It's not as big as it was last year, which is the yellow line, or the year before that necessarily, which again, that was like that Red Sea conflict stuff. You had some, both of those years were a little overheated due to pull forward, and I guess we had the cost prohibitive tariffs last year too.
And look how the yellow line drops off a cliff too. Right. I don't think that will happen this year. The yellow line was true. I mean, July of last year was the craziest month in the history of the Los Angeles. I mean, that's not a natural go straight up and straight down.
No, it's like both a recovery and a pull forward a little bit. Like it's like they didn't have May to pull in any, because it was 125% on Chinese freight. And then they were all of a sudden they were gone, and they were like, oh, let's order everything.
Right.
Yeah.
And so I think right now with the inventories, we're seeing a combination of it's going to be stronger than we thought.
Yeah.
And let's get a pull forward ahead of some of the potential tariffs. The bigger split, interestingly, is large firms versus small firms. Large firms came in at 68.6 in terms of inventory level increase. Small firms came in at 55.6. And I think that's explained by the difference in costs.
Yeah.
Because large firms are paying 81. It's 81.4 in inventory costs, which is very high. Smaller firms at 71.6, which is still high, but not as high. Spills over into warehousing. We're seeing an 81.9 for warehousing price for our big respondents and a 67.4 for smaller respondents. And it goes one more, transportation, 98.7 for transportation prices. Our scale only goes to 100. I don't think we've ever had a 98.7 before, and 87.7 for small firms. And so what that tells me is everybody's paying more, but our larger respondents are building up faster. One, they're disproportionately more of our larger respondents tend to be retailers. But the second piece is they may have the money in the bank where they can afford to be paying 80s and 90s for all of these cost increases. And the small firms, frankly, are sort of being left behind. They might not have the sort of nest egg to build up the way that the large firms are. And so I don't think we're seeing the same level of inventory pull forward. The larger firms essentially are dancing with the devil they know, which is the big costs we have right now. And the small firms, one, I don't think they have the financial capacity to do the same pull forward, but also so because of that, they're going to have to dance with the devil we don't know, which is whatever costs are going to be later on this year.
You know, Craig and Julie were interviewing Chris Wofford, financial institution, M&A, talking about the investment cycles and things like that before this show. And Craig mentioned, it's amazing like how much shippers will spend or have available to spend to just not miss a sale. Mm-hmm. Like, I mean, and it's interesting too, because, they're trying to keep all their costs down most of the time. And then all of a sudden, if somebody shows up to buy their stuff and it's not in stock, it's panic mode. I mean, I used to work in expedited freight back in the day. And it was incredible at some of the inflation and that some of these businesses would pay on these costs that they were spending 99% of the time. They were like pennies on the dollar trying to squeak everything out. And then the moment they needed it, air freight is a perfect example for this. When they need it, like they will spend whatever it takes to get it to where it needs to be. And I feel like we're getting some of that right now. I think
yes, especially on the retail side. It's oh my gosh, we might not be able to cover back to school, and that starts next month. And so let's rush it over as fast as we can. If anyone takes my intro to supply chain class, one of the question that's always on the first midterm is what's our most important job, and it's a fill in the blank. Constant assurance of supply. You can't run out. If you run out, then what do we even have a supply chain for? And I think that we're definitely seeing evidence of that right now with this sort of inventory stock up by our largest firms. And by the way, the spillover into transportation. Our transportation capacity was down this month to 30.8, which is a very low. I mean, that's a really, really robust contraction in terms of availability. And transportation price came in at 92.4. Now that's lower than where we were last month at 96, but that's still a really extreme rate of growth. And we talk about capacity and price all the time, but where we really saw the movement, I think this month, because of our low capacity and the high price, transportation utilization. Transportation utilization this month came in at 74.7. The last time we saw transportation utilization grow at a level this high was in the fall of 2018. So it's been 8 years since we saw utilization grow this quickly. If we look back at average utilization last year, it was about 55 all through 2025. So it grew at a sort of a slow rate. It even went negative a couple times. In 2026, it's growing at 66. So we're 11 points higher in terms of the average expansion of transportation utilization in 2026. It's literally a 50% jump from last fall when it was at 50 and now it's at 75. And so what that I think is telling us is, and it relates to what you're just talking about, it's like pulling an all-nighter. Like we will cram because of how expensive transportation is and because capacity is so low, we are not adding capacity at the rate you would expect us to given what price is. We're utilizing every last, square foot, square inch of space we can have. We have not seen utilization go up this consistently, really in almost 8 years in the index. I mean, it's kind of like what's happened is, you think, and we'll bring it back to economics one more time. Supply and demand graphs should cross like this. Right. We should always reach market equilibrium. Well, demand is way up here and supply isn't there yet. Right. Supply, we've been very slow to get back up to whatever that new equilibrium is. And because of that, utilization rates are going way higher. And like you were saying, we're trying to squeeze pennies out of every dollar we can on the freight side because supply and demand just aren't matching.
Oh, man. So we've got a minute and a half left. I need to get your outlook. 12 months from now, where do your respondents see transportation prices and capacity?
Okay. So a little bit easier. And what's so interesting is it's upstream that's really driving the shrinkage in capacity. Overall, transportation capacity expected to be at 42.4. Prices in 87, still utilization at 76. So that's pretty robust. Yeah, even higher than we are now. So pretty robust. Price moderating a bit. But if you break it down into, say, upstream and downstream does seem lighter. They actually are expecting an increase in capacity at 54. Oh. Upstream is 34. So we have a 20-point spread in that available expectation of capacity. And I think that comes down to a few different things, actually. One of them, I think, is downstream is thinking maybe we'll play back the 2025 playbook and jam everything at the wholesalers until the last second. And then price is about 4 points higher upstream, which you would expect because of constraints on capacity. There also could be some getting boxed out. And I don't know. It'll be interesting to see where it goes. I mean, basically, on both sides of the supply chain, we're expecting growth. What's interesting is our upstream folks, and this gets back to your manufacturing question, their inventories are sitting around 50. Downstream inventories are sitting at 68, but downstream costs are at 73. So think about that. There's a 5-point spread downstream between costs and levels. Upstream, inventory costs are 84. Inventory levels are 50. So there's a 34-point spread there. And what that tells me is upstream folks are expecting a disproportionately faster.
Presents the supply